Hello again, this is Phil at the Laptop Trader channel. Welcome back to our community. I'm here to share my experience and give back to the investing and trading community one video at a time. Good luck to you. My email contact is laptoptraderphil@gmail.com. Caution, most stock traders lose money. Please protect yourself at all times. Nothing discussed in this video is trading or investing advice. This channel is for information purposes only. We're going to cover a chapter 5 in our series of stock market basics. This is our agenda for the month. Why is Wall Street's favorite word growth? I think I'll demonstrate that to you. I've got 3 specific examples, 3 separate companies. Why do forward earnings propel growth in price or value? And how can we participate? Start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself and then invest in the markets. Caution, individual stocks are risk assets. The examples I'm going to show you are not the normal for stocks. Most stocks will not grow this much or go this high. But if you do participate in a good growth stock, it can really change your financial net worth. One of the reasons it is such a good idea to invest in the S&P 500 index or the Nasdaq index with a mutual fund is because you get the best companies in the best industries, and the fund management keeps the good companies that are growing and sells the companies that are not growing and underperforming. This is why diversification in many companies is a good idea if you are not willing to do the homework on individual company stocks. However, going into a potential stock in a smart way with limited risk and money management will really help you so you do not risk too much and put yourself in jeopardy. So why is growth so important? Because growth will generally outperform the market in general over time, which is about a 10.5% average, and will generally outperform dividend returns on a slow growth stock. There's nothing wrong with dividends or established companies. Sometimes the price is just stagnant. In our examples, we're going to make some assumptions as to what we paid for the stock and when we bought the stock shares. We are also going to assume you have some money set aside for investing. We do not have to go all in or overcommit to any one stock. Therefore, we should not put all of our eggs in one basket, and I will prove that to you. So here I just wanted to show you guys a comparison chart of, was it 6 different companies, and we've got NVIDIA, we've got the S&P 500, I've got the NASDAQ ETF QQQ, Amazon, AutoZone symbol AZO, PayPal, and Coca-Cola symbol KO, all graphed on the same chart. If you look towards the bottom of the chart, there's a bunch of lines, different colored lines at the bottom of the chart. But the one that really stands out is NVIDIA, the orange line, which severely outperformed everything else combined, showing a growth rate over this period of time, which was 5 years, of over 2,000%. The next closest stock on here is over that same time period is AutoZone at just under 200%. And then we have the underperformer of the group, PayPal, over the same period of time, minus 43%. And then kind of put Coke in here as a more established company, very solid company. Over that period of time, just in price, grew 31.2%. So these are not including dividends or share buybacks or stock splits. This is just pure price growth. You can see price growth over time can have a very big impact on your bottom line. Let's talk about if we took a basic investment, we went back in time and we look at NVIDIA company, symbol NVDA. The assumption is we purchased 100 shares in March of 2018 for $18 per share. So this would be an initial investment of $1,800. Very limited upfront investment using money management. This week's closing price of $898.78 per share. This week's closing gain, if we had held through this time period and did not sell, we would have grown our account to over $89,000, almost $90,000 over this time period. In just over 6 years, we have almost a 50x or 50 times our money in growth. 1,800 grows to 89,878. So you do not have to be rich to get rich, but you need to do some homework, have discipline, patience, and use money management. Well, here is a chart of NVIDIA. This is, again, a 5-year chart. So this is a little bit less time than what I'm suggesting. That example goes back just over 6 years. But you can see clearly on this 5-year chart just the growth in price. And NVIDIA also pays a dividend. So this is a very valuable stock, has great earnings, and you would have actually had even a better return on investment had we counted dividends. So it just shows what growth can do for your account or your net worth. Now let's talk about a basic investment in Amazon company, symbol AMZN, right? Obviously a very popular company. I don't think anybody out there hasn't heard of Amazon. Well, if you had invested in Amazon 24 years ago, in May of 2000, let's look at some numbers. You could have had an initial investment of only $242, which would have purchased 100 shares at $2.42 per share. At the time, the market and Amazon were in a downtrend, and the low was in October of 2021 at only 28 cents per share. Now, on this one, you did not need to pick the low or even be correct in your timing. Why? Because the growth and the fundamentals over time took over and prices moved up significantly over time. So I'm suggesting here, 24 years ago, you actually bought the stock of this valuable company while it was in a downtrend, maybe probably in a bear market for the whole market. I'm not sure on that, but last price for this week was $187.48 per share. So you could have turned $242, could have grown to over 18,000 in 24 years. So that's 77 times your money. Not 77%, 77 times. So do you have the discipline to save $242 and hold on to a good stock? I did not. I thought the company would not have made it over time just selling books. So this is one I missed. And one of several I've missed, to be totally honest. But that's okay. So here's the same time period, of Amazon. Now this again, this is only over 5 years, but um, it just shows. I'm just trying to show on this chart the just the back and forth movement of price over time, and how sometimes if you can get a really good deal up front, you can ride through these periods of stage one, stage three, and stage four, and hold on for that next growth cycle, which Amazon is in right now. So just made a new high, closing high this week. So Amazon still looks like a very good company as of the time being. Let's talk about one more, so we can just continue our discussion on growth and getting good deals. But a basic investment in AutoZone company, symbol AZO. So in May of 2000, AutoZone closed at $28 per share. A 100 share investment would have cost $2,800. Well, you do not have to buy 100 shares if you can't afford to, but you could buy 10. And the closing price this week, in May of 2024, was $2,979.32 per share. A closing investment, if you did not sell over this period, of $297,920. That's over a 106 times your money in 24 years. Will most stocks perform this well? No. But you can't win if you don't get in the game. 10 shares would have only cost $280. Why did AutoZone perform so well? Well, they are a market leader. They had a good business and earnings growth. They don't pay a dividend, and they did not split the share price or dilute the shares. There's a 10-year chart of AutoZone. You can just see the price over time generally just kept going up, over $2,900 per share. So think about that. It turned $2,800 into over $297,000. I also wanted to have a discussion with you guys on recent performance of AutoZone. I'm not saying this is a good buy, but just good companies tend to outperform in most market environments. If we look here to the right, this is just a quick little graph comparing the last 3 months of price, AutoZone versus the market in general, right? The SPY, SP 500 ETF from Vanguard, and other ETFs. Here's a total stock market index from Vanguard. But look at that, AutoZone is still outperforming at over 11% growth over 3 months. So sometimes price may seem expensive, but it's still performing very well. So let's talk about how can we participate. So here's some quick tips, 3 quick tips for finding growth stocks. First of all, invest in what you know and use. I must have been in AutoZone over 100 times over the years and simply did not pay attention to the company story or growth or even consider buying stock in the company. I didn't even know it was a public company. So this is just a reminder to pay attention. I should have been in AutoZone. I knew about the company, and I just didn't pay attention. I wasn't interested in stocks at the time. Think of what is new and exciting right now, or what is popular. Think of podcasts or streaming video or ride sharing. New ideas that come to the market. That's where you're going to get growth. New ideas, new companies, something new and exciting. Finally, do some homework and see what do their metrics or their fundamentals look like. Are they profitable or have plans to grow and become profitable? Are earnings per share growing, right? Growth is the number one word on Wall Street. And earnings per share drives price sometimes. Is the chart moving up? Is price appreciating? Is the stock making new highs in price? I also want to share this page with you because this gives an example of one of my watch lists, and it just shows um, what was on my list at certain times. So here you can see at the top, Apple Company, last price um, as of Friday. But I added this to my watch list when Apple was at just under 42 bucks a share back in 2018. So since that time, since I've been trading individual stocks, Apple has grown in price almost 336%. Right? So again, a very valuable company, still growing since that time. And you can also see other ones on my watch list like eBay, right? Ford, just a dog, only grew 4% since 2018, and others. So here's Fluor. This was kind of a surprise to me. Fluor has grown over 100% since 2021. Um, Home Depot has almost grown 100% since 2018, and others. But obviously, the one that stands out again is NVIDIA, right? This was on my list at $15.40 in 2018. It's grown over 5,000% since that time. So pay attention to what's on your watch list. That's the lesson there. So why do growing earnings per share propel growth in stock prices? Let's use an example of ABC company. It's just a fictional company. But for example, if they report earnings per share of 50 cents per share this quarter and also offer forward guidance of doubling earnings by next year of $1 per share, then Wall Street is probably willing to pay more for that growth. Remember, reported earnings per share is a report card for the last quarter. If Wall Street has evidence from the company saying growth will double over the next year, they are looking forward to participate in that growth as investors in that company. And I would also add they really pay attention to earnings per share growth for the last year also. So if we're looking at May of 2024, it's a good idea to look at what the earnings were for May of 2023 and compare those two numbers also, which I've shown you guys that before. If the stock is trading at $30 per share, then it may be reasonable to assume a forward stock price of 60 per share a year from now. This is assuming all other factors for the company did not change and that the economy is growing at the same rate or at least stable. These are big assumptions, as there is always change, and we don't know what changes are ahead. For example, if the company grows earnings per share as expected, while at the same time also doubles their market size, like adding stores or adding customers, then these factors can really accelerate growth. This is also why you want to limit your investment to an amount you are very comfortable with, and why money management is so important. What if the forward estimates were wrong? So this happens too. Let's think about Apple Company, symbol AAPL. It is one of the reasons Apple has been such a great investment over the last 2 decades. Growth in customers using Apple products and services like the iPhone and their subscriptions. Growth in sales and revenues and earnings per share, along with growth in stock price and dividends. Apple is one of those companies that is a market leader in a growth sector, technology, has loyal customers, great products, and has rewarded investors in growth in all the key areas: dividends, splits, buying back shares, the share price itself, earnings per share, and is very popular and a Wall Street favorite. Investors have been willing to pay ever higher prices to participate in the stock and the story of this company. This is why, in a chart, stocks making new all-time highs is a good place to start your search for growth stock investments, because investors are paying up for that stock. They must see something in the numbers to compel them to pay higher prices for this stock. This is not like shopping at the discount store looking for lower prices. We want our money to grow. Think like an investor, not a broke person looking for sale prices. Let's also have a quick discussion on ratios. A PE ratio, or price to earnings ratio, is a way to compare stocks within a sector and or an industry as a way to assess value or valuation in comparison to a company's peers. It can be used for determining if a stock is under or overpriced. A PEG ratio, or price earnings to growth ratio, sometimes they'll just say PEG ratio, is used to compare a company's valuations regardless of industry, as it takes into account a stock's future earnings growth in comparison to price. Also used for determining under or overpriced. ROE, or return on equity, is a measure of a company's net income divided by its shareholders' equity. This is just a gauge of a company's profitability. General, the higher the number, the better. And I've heard over 20% is really desired when it comes to ROE. There are others used for comparison, such as price divided by sales, price divided by book value, price divided by cash flow, debt divided by equity, and others. These are just tools to assess a company's value and or performance and can be useful. But remember, the one factor in these ratios that is most important is price. Just because a stock has a high ratio does not mean that price can't go higher. Also, in your search for growth stocks, identifying a company early with a low ratio may just mean that it is not popular yet. And if you bought a few shares now, you may get the benefit of price accelerating higher as the ratios move higher at the same time. Other factors to consider may be how many shares are outstanding, as earnings per share is affected by outstanding shares or share buybacks or a company issuing more shares. Again, before I make a decision, I will consult a chart to check the price and the trend of the price over time. Is price moving up or down? One of the main factors is also growing earnings per share. Just look at the numbers on Tesla versus Nvidia, and you will see why Tesla is in a downtrend now. When you put all of these clues together for yourself, it should give you a good picture of, is this a good investment at this time for me? Just be aware of these terms and ratios and use them to your advantage. These ratios and metrics are not the be all end all of analysis. Price is king. Sometimes these ratios can be ignored if a stock is very popular and investors are willing to pay up for future earnings. The market or life in general is not going to give you anything. You need to earn some money, save some for investing or trading, and then choose wisely. Rich people did not get rich by being lazy or not investing. Budgeting and money management sucks, but so does the alternative, not having money. I know it is not fun when others around you have new cars or homes or furniture on credit and look good, but the truth is most people are broke and a paycheck away from being bankrupt if they lost their job. Be smart. It takes discipline to show up to work every day and save and invest long term, but you can do it. I know I showed examples from the past, but there are opportunities right now to invest in. Have you saved $500 or $1,000 for your next investment? The next investment is around the corner. Are you ready for it? Three books to consider that really helped me: Beating the Street by Peter Lynch, Stocks for the Long Run by Jeremy Siegel, and How to Make Money in Stocks by William O'Neill. I just typed into Google, what is the average car payment? Let's analyze what that shiny new car is really costing you. According to Google, average monthly car payment for new cars is $726. The average monthly payment for used cars is $533. So this is a really helpful tool at investor.gov. It shows a compound interest calculator, and you can just type in an initial investment of your choice. I typed in $1,000 as an initial investment, and then I typed in below that, I typed in a monthly contribution, and I just put in the average car payment, which seems really high to me. $726 a month is a lot of money for a car. And then I typed in the length of time in years that I plan to save that payment. So I just put $1,000 initial investment, monthly payment, 726 over 10 years, and I put in a basic interest rate. The market average over time has been just over 10.5%. I just put 10, okay? So I'm not getting carried away with some kind of outsized returns here. This is just the market average. And then I put in an interest rate variance range. I put 1, so that means interest, your return on investment could be plus or minus 1. And so that means, it may go up a little bit, it may go down over this period of time by 1 point. So it could either be 11, somewhere between 9 and 11% return on investment. Now you can play with these numbers yourself. Just type in your car payment into this calculator and see what comes out. But the results are in. Okay, in 10 years, you will have about $141,400 in savings just by saving a car payment. Remember, that's the average car payment. There's people paying a lot more than that, and there's some people paying a lot less. So type in your numbers and see what comes out for you. That's only 10 years. Most people are going to be saving and investing for longer than 10 years. Guys, the results are in. 10 years, what do you think that new car will be worth? Easiest way for you to be stuck in your job for the next 40 years is to always have a car payment. I know what most will say. I have to have a car anyway, so it might as well be a nice one. Well, most people are not rich and they're broke. The results are in, and it is a choice. You could have a new car, or you could have a nice start to a big nest egg. Type in your current car payment into this great calculator at investor.gov. See for yourself. I simply typed in the average car payment and applied a 10% rate of return, ROI, and out came the numbers. What if you became better at choosing stocks over the next 10 years and had some big winners? You can save and invest if you choose to, so good luck. Thanks for watching, sharing, and subscribing to Laptop Trader. See you next month.